Welcome to Book Summary Podcast, your gateway to personal transformation. Each episode delivers big ideas from the world's most impactful books on mindset, productivity, and success, all in just a few minutes. Ready to turn knowledge into action? Let's get started.
Welcome to the Deep Dive. Our mission today, well, it's pretty simple. We're cutting through all the noise, the complexity, the sort of emotional static around building wealth.
Right. We want to give you a framework, something actionable, data-driven for your finances.
Exactly. We've pulled together a whole lot of research, and it all seems to point towards one clear path to success. And the interesting thing is, it works regardless of what the market's doing.
And that path, it's really encapsulated in just 3 words, a philosophy that acts as, well, both a rule and kind of a psychological anchor.
Yeah, we're trying to give you, the listener, a shortcut, a way to know when to save, when to invest, and maybe just as importantly, how to tune out all that financial chatter.
So let's start there with those 3 powerful words. We'll unpack why this idea works when saving absolutely has to be your priority over investing.
And we're going to challenge some really deep-seated financial myths, like the idea that all debt is bad. Turns out some debt can actually be, well, rational.
Okay, so the philosophy itself, just keep buying.
Yeah, KB.
JKB, I like it. Formally, it's called dollar cost averaging, DCA. But just changing the name to JKB, it adds this psychological drive, this motivation that the technical term just doesn't have.
Okay, let's unpack that psychological power. There's a story, it's a bit somber, but it really drives home the relentless, almost automatic power of JKB. We're talking about a late grandfather who unfortunately struggled with a pretty severe gambling addiction.
Yeah, it's a tough story, but illustrates the point well. Yeah. He was lucky enough to retire early, around 55, and he had almost no living costs because he lived with his mother.
Okay.
He had this guaranteed income every month, about $2,200, $1,000 from his pension, $1,200 from Social Security. But the tragedy is he spent the next 26 years gambling away every single dollar. Blackjack, pay-gal, just gone.
26 years, wow. And when he passed away in 2019, he had nothing left, no assets. Just a profound story of addiction.
Exactly. But here's the kicker, the statistical truth behind JKB. If he had just taken half of that money, the $1,100 a month, he was already mentally budgeting for immediate loss and consistently, automatically put it into a simple, broad U.S. stock index fund every single month, he would have died a millionaire.
A millionaire, even after gambling away half his income.
Yes. And this is the critical part. His consistency, even though it stemmed from this terrible habit, that consistency would have beaten the market's volatility. And remember, he would have been investing right through the 2000s, 2000 to 2009, one of the absolute worst decades for stocks in recent memory.
So consistency basically acts like a shield. It protects you from bad timing.
That's the core of JKB. It turns investing into just a habit, like brushing your teeth, paying your rent. It takes the emotion out, removes that urge to try and time the market, to react when things get scary.
And doing that habit is easier today than ever before, right?
Oh, absolutely. Think back just a couple of decades. The 90s, if you tried to just keep buying back then, you'd be paying fees constantly, maybe $8, sometimes more, for every single trade.
Ouch. So buying small amounts regularly would have just eaten up your returns and fees.
Totally. Thousands of dollars over time.
Yeah.
But today, it's practically frictionless. We have free trading platforms everywhere. Fractional shares mean you can buy, $10 worth of inexpensive stock. Diversification through index funds costs next to nothing.
So that barrier, the cost barrier, it's just gone. JKB is more accessible, financially speaking, than it's ever been.
Precisely. So that's our foundation. Now, we take this simple idea, just keep buying, and we apply it to the more complex stuff. How much should you save? How do you handle debt smartly? We use data, not guesswork.
All right, let's start with figuring out where you should actually be putting your focus right now. Your energy. Okay, part 1, the Save Invest Continuum. We're trying to help you figure out, should you be spending your limited time obsessing over saving every penny? Or should you be deep in the weeds of investment strategy?
And we start with a line that's, designed to maybe grab your attention. Saving is for the poor, and investing is for the rich.
Okay, hang on. We need to clarify that immediately.
Absolutely. We mean poor and rich purely in terms of accumulated financial capital. If your portfolio is small, relatively speaking, you're poor in financial capital. Your biggest lever is saving more.
Got it.
If your portfolio is huge, you're rich in financial capital. Investment strategy, asset allocation, risk management, that's what drives your financial future.
This really comes alive with an example. Let's take the recent college grad. Picture someone, say, 23 years old, maybe living in a high-cost city like San Francisco. They've been working a year, managed to save up maybe $1,000 in their 401k or brokerage account.
Okay, standard scenario. And what do they often do? They spend hours, maybe hundreds of hours, scrolling finance forums, tweaking their allocation. Should it be 10% bonds, 15%, maybe add a specific sector ETF? They're trying to squeeze every last bit of return out of that $1,000.
Right, optimizing to the decimal point. But at the same time, this same person might easily drop $100, maybe more, on a single night out, dinner, drinks, and Uber home.
And the math here is just brutal. Let's say they have an amazing year, get a 10% return on that $1,000. That's $100 over the entire year.
That one night out just wiped out 12 months of potential investment growth.
Exactly. It highlights the mistake. For that young saver, the person who's poor in financial capital, the highest return on their effort isn't fine-tuning the investment mix. It's savings discipline.
Cutting back on that one expensive night or maybe negotiating rent a bit lower, that saves way more money, delivers a much bigger immediate return than tweaking the bond allocation on a small portfolio.
Now let's flip it. Contrast that with someone later in life, the rich phase, financially speaking. Imagine someone who's built up a $10 million portfolio.
Okay, big difference.
If the market has just a normal pullback, say 10%, which happens pretty regularly, they lose $1 million, just like that.
$1 million. Unless they're earning an absolutely massive salary, their yearly savings, maybe $100K, $200, it's just dwarfed by the portfolio's movement.
Completely. So their focus has to shift. Their time is best spent on investment strategy, risk control, tax efficiency, really digging into asset allocation decisions. They're not worrying about a $100 dinner anymore. They're managing $1 million swings.
So how do you figure out where you are on this spectrum? You mentioned a formula?
Yeah, it's pretty straightforward. You just compare two numbers in dollar terms.
Okay.
Number one, your expected annual savings. How much new money do you plan to save and invest this year? Let's say $15,000.
Got it. $15,000 saved.
Number two, your expected annual investment growth. Take your current portfolio value, multiply it by a reasonable expected return. Maybe 10% if you're mostly in stocks, maybe 7% or 8% if it's more balanced.
Okay, so let's say my portfolio is $30,000. At 10%, that's $3,000 in expected growth.
Right. So in that case, your expected savings, $15,000, is way higher than your expected investment growth, $3,000. Your main focus should be on boosting those savings, finding ways to earn more, spend less efficiently.
Makes sense. And the other way around. If I save $15,000, but my portfolio is, say, $1.5 million, expected growth is $150,000.
Then your focus absolutely has to be on managing that portfolio growth, optimizing the investments. Saving is still good, but the big dollars are moving within the portfolio itself.
And if the numbers are close, say $15,000 saved and $20,000 expected growth,
then you focus on both. You're kind of in that transition zone.
this isn't just theory either. You can see this shift play out over a career, right?
Oh, definitely. If you visualize wealth building over 30 years, in the first decade or so, most of your portfolio growth comes directly from the money you save each year. Your contributions are the main engine.
But then compounding starts to kick in.
Exactly. By the end of a typical working life, maybe 30 or 40 years in, the numbers flip dramatically. Something like 70% of the total wealth you've accumulated often comes from the investment gains themselves, not the money you put in during those later years.
Because the money you invested early on is working harder for you than your current paycheck can.
Precisely. That's why knowing where to focus your energy now, based on your current level of financial capital, is so vital.
Okay, that focus on savings naturally leads us into part 2, where we tackle what you call the saving paradox. And we have to start by pushing back against some common financial advice that just feels static, doesn't fit real life.
Right, we're talking about those rigid rules like you absolutely must save 20% of your income, or you need 1x your salary saved by age 30.
Yeah, those benchmarks can feel pretty stressful.
And they're fundamentally flawed because, well, life isn't static. Academic research shows pretty clearly that our income, our expenses, our ability to save it all fluctuates. Life is messy, it's dynamic.
So we need a more flexible approach. Use a biology analogy.
Yeah, it's called phenotypic plasticity. Think about the Dolly Varden charts, a fish found in Alaska. When food is scarce, these fish literally shrink their digestive organs to save energy.
Wow, really?
Yeah, and then when the salmon run starts and there's tons of food, their digestive tracts expand, sometimes doubling in size, to take advantage of the abundance.
Okay, I see where you're going. Our finances need to adapt like that fish.
Exactly. If times are lean, maybe you're a student, you moved took a pay cut for a new career, you have to be okay with saving less. Forcing yourself to hit a rigid 20% target when your necessary expenses are high just leads to misery.
And misery is definitely what we want to avoid. Money stress is a huge issue.
It's consistently the #1 stressor for Americans, according to the APA, going back to 2007. So the best savings advice isn't hitting some arbitrary percentage. It's saving what you realistically can in a way that minimizes stress and doesn't make you obsess.
So how do you find that number, the what you can save number?
It's the simple equation: savings, income, spending. Income is usually pretty straightforward. Spending is the tricky part.
Right, the variable part. Do you need to track every single coffee?
No, not necessarily. That hyper-tracking can actually increase stress for some people. The key is to get a good handle on it. Know your fixed costs, rent, insurance, subscriptions you can't easily cut. Then estimate your variable spending. If you generally spend about $100 a week on groceries, budget $400 a month. Use reasonable estimates. The goal is clarity and control, not perfect, down to the penny accounting.
Got it. Approximate to understand. Now, let's use that reality check to tackle what you call the biggest lie in personal finance.
Yes. The idea that simply cutting your spending is enough to make you rich.
The latte factor argument, essentially.
Exactly. And this lie is, frankly, quite harmful because it ignores the economic reality for a huge chunk of the population.
Yeah.
We have to look at the data, specifically the Consumer Expenditure Survey data, for the bottom 40% of U.S. households by income.
Okay, what does that data show?
It's sobering. Since they started tracking in 1984, the lowest 20% of households have consistently spent more than 100% of their after-tax income on just 4 basic necessities: food, healthcare, housing, and transportation.
More than 100%, just on basics.
Yes. In one recent year we analyzed, their average after-tax income was about $1,020 a month. They're spending on just those 4 essentials, $1,947 a month.
Wow. They're spending almost double what they earn just to cover the absolute basics.
Right. So for someone in that situation to save any money, they'd need to cut their spending on necessities by nearly half. That's just,
Yeah.
it's not realistic. Telling them they're poor because they bought the wrong brand of soap or occasionally get a coffee is mathematically absurd and, frankly, insulting.
So the ability to save meaningfully isn't really about willpower at that level. It's about income.
Absolutely. It comes down to income and the law of diminishing marginal utility. We call it the law of the stomach.
Okay.
Think about pizza. That first slice, amazing, right? A third slice, still good, but you get less additional joy from it.
Right, the satisfaction diminishes.
Spending works the same way. High-income folks don't increase their spending proportionally with their income. The data showed the top 20% of earners made 14 times more after-tax income than the bottom 20% in 2019. But they only spent 3.3 times more on necessities.
Ah, so that huge gap between income growth and necessity spending growth, that's where the surplus comes from. That's the money that enables aggressive saving and investing.
Precisely. And this ties into the concept of the poverty trap. Research from the London School of Economics in Bangladesh looked at this. They found it wasn't lack of talent or drive keeping people poor. It was lack of initial capital.
How did they show that?
They randomly gave some female villagers enough capital like livestock to get them above a certain asset threshold. Those women were able to escape poverty permanently. But if the women received just slightly less than that critical amount, they eventually slid back into poverty.
So having that initial cushion, that starting capital, is crucial.
It's absolutely critical, which tells us, for most people, the best path forward isn't agonizing over tiny expenses. It's focusing on increasing income.
Which makes the skip the latte, become a millionaire advice seem even weaker.
It often relies on really unrealistic assumptions, like needing a 12% annualized return over decades to make the math work. The long-term market average is closer to 8–10%. It's just not sound advice for most people's situations.
So the focus needs to shift to growing your human capital. Explain that.
Human capital is simply the economic value of your skills, your knowledge, your time. The goal is to convert that human capital into financial capital money that you can then invest.
And how do you do that? What are the methods?
Well, there are several. You can sell your time or expertise directly, like traditional consulting. But that doesn't scale well. You only have so many hours.
Right.
You can sell a specific skill or service, often pays better, helps build a brand, but you still have to deliver the work each time.
Okay.
Then there's teaching people. This is highly scalable, especially with things like pre-recorded online courses or info products. Build it once, sell it many times. Same goes for selling a digital product that solves a specific problem. High margins, very scalable.
Build once, sell infinitely. Nice.
But let's be realistic. For the vast majority of people building significant wealth, the most common path is still climbing the corporate ladder. Building expertise, getting promotions, increasing that salary over time.
And it's worth noting, the stereotypical entrepreneur isn't usually a 20-year-old dropout. The average successful founder is closer to 40.
Exactly. They often build human capital and financial capital in a traditional career first. But the ultimate goal, whatever path you take, has to be ownership.
Ownership, as in owning assets, not just earning a salary.
Precisely. Think of Jerry Richardson. He played a couple of years in the NFL. He didn't get rich from his player's salary. He became a billionaire by owning Hardee's franchises and eventually the Carolina Panthers NFL team. Ownership creates wealth in a way labor income rarely does.
Okay, that's a powerful distinction. Now let's shift to something maybe more fun, spending guilt-free. Because once you are earning more, investing consistently, you should be able to enjoy it, right?
Absolutely. But spending anxiety is real, even for people with a lot of money. So we introduced the 2X rule.
2X rule. Okay, how does it work?
It's simple. If you want to splurge on something, say a $500 weekend trip, a $400 gadget, you have to immediately match that amount with an equal investment into income-producing assets, like index funds, or a donation to a charity you care about.
So $400 on the gadget means $400 goes into your brokerage account or to charity simultaneously.
Exactly. Psychologically, it reframes the spending. It becomes guilt-free because you've already accounted for your future self or contributed to something meaningful. It shifts your mindset from scarcity to, okay, I can enjoy this because I'm also building wealth or giving back.
I like that. It connects spending to saving directly.
And beyond just guilt, we should aim for maximizing fulfillment, not just momentary happiness.
What's the difference?
Happiness can be fleeting. Fulfillment is deeper, longer-lasting satisfaction. Think about training for a marathon. The moment-to-moment running isn't always happy. It can be painful, but crossing the finish line brings immense fulfillment.
Okay, so how do you filter spending for fulfillment?
We like Daniel Pink's framework: autonomy, mastery, and purpose. Ask yourself, does this purchase enhance my sense of control? Autonomy. Does it help me get better at something important? Mastery. Does it connect to a larger sense of meaning? Purpose.
So if buying, say, a really good standing desk helps you work better and feel more in control of your health while working enhances your occupational mastery, then it's justified spending.
Precisely. And ultimately, spending has to be personal. Research shows that spending money in ways that align with your own personality traits actually leads to higher life satisfaction than just having a higher income does.
So there's no single right way to spend. It's about finding what works for you.
Exactly. Spend in a way that maximizes your personal fulfillment, using frameworks like the 2X rule and autonomy, mastery, purpose to guide you.
All right, moving into part 3, let's tackle some of the really big financial decisions, starting with that constant battle, lifestyle creep.
Yes, the silent wealth killer. The cautionary tale here is, well, epic. The House of Vanderbilt.
A railroad tycoon.
The Commodore, yes, amassed a fortune worth maybe $5 billion in today's money. Huge wealth. But within 75 years of his death, he was basically all gone.
$5 billion. How?
Just unbelievable, extravagant lifestyle creep. Stories of heirs smoking cigarettes wrapped in $100 bills, having dinner parties on horseback inside mansions, just spending money at a rate that no investment return could possibly keep up with.
Okay, so maybe don't wrap your cigarettes in cash. Got it. But for the rest of us, what's a practical rule?
Simple, effective rule is this. Save 50% of all your future raises and bonuses.
50%. So if I get a $10,000 raise, $5,000 goes to savings investing, and I can spend the other $5,000.
Exactly. The modeling shows that once you start spending more than half of your raise, you begin to noticeably push back your retirement date. But there's a twist here, something counterintuitive we call the high saver trap.
High saver trap. Okay, explain that. If I'm already saving a lot, say 50% of my income, shouldn't I be able to spend more of my raise? I'm already doing great.
Logically, you'd think so. But the math works the other way, and it's really important to grasp this. If you're already saving 50%, your actual spending base is quite low.
Right. My expenses are controlled.
So when you get a raise, that new money is actually a much larger percentage increase relative to your low spending level. To maintain your original ambitious retirement timeline, you actually need to save an even higher percentage of that raise, maybe closer to 74%, compared to someone who only saves 10% initially. They might only need to save 36% of their raise to stay on track.
Wow, that's completely backward from what I'd expect.
Yeah.
So the 50% rule isn't perfect for extreme savers, but it's a good general guideline.
Exactly. It's simple, easy to remember, and works really well for the vast majority of people who save somewhere between 10% and 25% of their income. But if you're already a super saver, you need to be even more disciplined with new money to keep accelerating at the same pace.
Good problem to have, I guess, but definitely something to be aware of. Okay, next big topic, debt. Financial gurus often paint all debt, especially credit card debt, as pure evil.
Yeah. And that lacks nuance. Debt is just a financial tool. It can be used wisely or unwisely. We need to understand why people sometimes use debt in ways that seem irrational at first glance.
Like the borrower-saver puzzle.
Exactly. This is where people hold, say, high-interest credit card debt while also having money sitting in a low-interest savings account. Why? It's often a form of bet hedging.
Bet hedging, like they're worried about something.
We're worried about future access to credit or needing cash immediately. Think of desert seeds that don't all sprout at the first rain, holding back in case it's a false start. These people pay the short-term cost, interest, to reduce the long-term risk of being completely illiquid if something unexpected happens and they can't borrow later.
Interesting. There is an example from India.
Yes, Seema. She took out a high-interest loan even though she had savings. Why? Because the pressure of that high-interest repayment acted as a forced savings mechanism for her. It created discipline she felt she lacked otherwise, preventing her from dipping into her cash savings.
So debt can sometimes be a behavioral tool, not just a financial one. When is debt justifiable from a purely financial perspective?
Generally, debt is justifiable when it either reduces your overall risk or it generates a return higher than its cost.
Okay, reducing risk, like a fixed-rate mortgage.
Perfect example. It locks in your housing costs for potentially 30 years, providing huge payment stability and predictability. That reduces financial risk.
And generating a return.
Think student loans for a degree that significantly boosts your earning potential, or a loan to start a business with a solid plan, or even buying a home you plan to live in long-term, which builds equity, albeit slowly. The expected return, financial or otherwise, outweighs the interest cost.
But there's a big warning label needed here, right? Especially for certain types of debt.
Absolutely. We have to be really clear. High interest, non-mortgage debt, credit cards, payday loans, even sometimes loans from family or friends, these are consistently linked in studies to negative outcomes. Increased stress, depression, higher blood pressure.
Unlike mortgage debt, which doesn't seem to carry the same psychological burden.
Generally, no. That toxic debt cycle needs to be avoided. Pay it down aggressively. It's usually not justifiable.
Okay, let's talk about the biggest debt for most people. The mortgage. The homeownership decision. You have a somewhat controversial take here. A house isn't actually a great investment.
Strictly speaking, from a pure financial return perspective, no. This often surprises people. But Nobel laureate Robert Shiller did the math. He looked at U.S. housing from 1915 to 2015, the inflation-adjusted return, only 0.6% per year.
0.6% over a century. Basically flat after inflation.
Pretty much. Housing is way less volatile than stocks, which is good, but it's very unlikely to be the primary engine driving your massive wealth creation compared to equity investments.
So if it's not a great investment, why buy a house at all?
For all the non-financial reasons. Stability for your family, building community ties, access to schools, that sense of place and psychological security. These things are incredibly valuable.
And for some people, it is their main wealth builder, right?
Yes, particularly for lower-income households. Often, home equity represents 75% or more of their total net worth. The mortgage acts as a forced savings plan as they pay down the principal month after month.
Okay, so buy for stability and lifestyle, not primarily for investment return. When is the right time to buy?
When your life is stable, personally, professionally. You should plan on staying put for at least 5, ideally 10 years or more. Why? Because the transaction costs of buying and selling are huge. Agent commissions, closing costs, moving expenses. You need time for the house to appreciate enough just to cover those costs.
And financially?
You need to be able to afford a 20% down payment, ideally, to avoid private mortgage insurance, PMI. And your debt-to-income ratio, or DTI, all your monthly debt payments divided by your gross monthly income, should generally be below 43% to meet the qualified mortgage standard.
You also recommend skipping the starter home.
Generally, yes. Those transaction costs we mentioned. Paying them twice, once when you buy the starter home, again when you sell it, and then again when you buy the bigger home, it eats up a massive amount of potential equity.
So, better to wait, save more aggressively, and buy the home you plan to be in for the long haul, if possible.
I think for many people, yes. Patience pays off here.
Okay, let's talk about saving for that down payment. It can take years. Where should you keep that money while you're saving? The time horizon matters hugely here.
Absolutely. If your timeline is short, say less than 2 years away from buying, that money has to be in cash, savings account, money market fund, something safe.
Even though it earns basically nothing, why not put it in bonds for a little extra yield?
Because even relatively safe intermediate-term bonds can easily drop 3% or more in value if interest rates move unexpectedly. Imagine that happens right before your closing date. Suddenly your down payment is short, you might have to scramble for another month's savings, maybe even lose the house. Cash eliminates that volatility risk over the short term.
Okay, short-term cash. What about longer term? Saving for 5 years or more?
And holding cash actually becomes the riskier option because of inflation.
Inflation eats away at the purchasing power.
Exactly. We looked at historical data. If you were saving, say, $60,000 over 5 years entirely in cash, on average, you'd have needed to save for an extra 7 months just to make up for the purchasing power lost to inflation during those 5 years.
Wow. So holding cash long-term guarantees you lose ground.
It guarantees a loss in real terms. Over 5 years or more, you really need that down payment fund invested in a balanced portfolio, maybe a conservative mix of stocks and bonds, to have a good chance of outpacing inflation and actually growing your purchasing power.
Makes sense. Time horizon dictates risk tolerance. Okay, the ultimate question. When can you actually retire?
The million-dollar question, or maybe multi-million-dollar question. The classic financial answer revolves around the 4% rule.
Developed by William Bengen, right. Explain it.
Right. Bengen figured out, based on historical data, that if you withdraw 4% of your starting portfolio value in your first year of retirement, and then adjust that dollar amount upward for inflation each subsequent year, there's a very high probability your money will last for at least 30 years, even with a balanced stock bond portfolio.
So it's a safe withdrawal rate guideline. How does that translate into a savings target?
If 4% is your safe withdrawal, then you need a portfolio that's 25 times your desired annual spending from that portfolio, because 1 divided by 0.04 is 25.
25 times, but not total spending, right?
Right. It's 25 times your annual excess spending. That's your total planned spending in retirement, minus any guaranteed income you'll receive, like Social Security or a pension. If you need your portfolio to cover $40,000 a year beyond Social Security, your target number is $40,000 times 25, which is $1 million.
Okay, 25x the spending the portfolio needs to cover. Is the 4% rule still considered reliable?
It's generally seen as quite conservative, actually. It assumes your spending keeps pace with inflation every single year. But studies of actual retiree spending show that, on average, spending tends to decline by about 1% per year in real terms as people age and become less active.
So the rule builds in a buffer. The risk of running out of money adhering to it is pretty low.
Very low, historically speaking. But hitting the number is only half the battle. The bigger challenge for many people isn't the math, it's the existential side of retirement.
Meaning, what do you do all day?
Exactly. Work provides so much more than a paycheck. It provides identity, structure, social interaction, a sense of purpose. We saw the story of Kevin O'Leary, Mr. Wonderful, from Shark Tank. He sold his company, retired at 36, and was apparently bored out of his mind.
Yeah, I can imagine. The FIRE movement, financial independence, retire early, some people achieve it and then find it empty.
Some do. They describe it as a lonely existence without the structure and challenge of work. Many end up going back to work on projects or even starting new businesses within a few years.
So the real retirement planning isn't just saving the money. It's figuring out what you're retiring to, what will provide that purpose, that engagement.
Precisely. The money gives you the option, but you have to build the life you want to live in retirement. The financial independence is necessary, but not sufficient, for a fulfilling retirement. Which leads us nicely into part 4, the investment imperative. Why investing isn't really optional if you want financial independence. It boils down to replacing your human capital.
Human capital, the value of your future work and earnings. And that's a finite resource.
It's a dwindling asset. Every year you work, there's one less year of future earnings potential. Let's put a number on it. If you earn, say, $50,000 a year and expect to work for 40 years, what's the value of that entire future income stream today?
Like the present value.
Exactly. Discounted back at a reasonable rate, maybe 3%, that $50,000 a year for 40 years income stream has a present value of roughly $1.2 million.
Wow. So to replace my paycheck indefinitely, I essentially need $1.2 million in financial capital working for me.
That's the core idea. Investing is the process of converting that diminishing human capital, your ability to work, into durable financial capital assets that generate income for you even after you stop working.
So to do that conversion effectively, you need to own the right kind of assets, specifically income-producing assets.
Yes.
Mm.
We need to look beyond just the standard stock-bond mix sometimes. Let's quickly review some options, and this isn't specific advice, just categories to be aware of.
Okay.
First, the bedrock. Stocks, equities. Historically, maybe 8–10% average annual returns. High volatility, but the best long-term growth engine generally.
Got it. Stocks.
Next, real estate investment trusts, or REITs. These often show slightly higher historical returns, maybe 10–12%. They give you exposure to real estate office buildings, apartments, malls, without you having to be a landlord.
And they have a specific structure that's good for income investors.
Yes. Legally, REITs must pay out at least 90% of their taxable income to shareholders as dividends. That mandate makes them very reliable cash flow generators.
Interesting. Okay, what else?
Farmland. Returns historically around 7–9%. The key benefit here is low correlation to the stock market. Farmland prices often move independently of stocks, making it a good diversifier and potentially a decent inflation hedge.
Low correlation is valuable, then the really high-risk stuff.
Right. Small businesses and angel investing. This is where you see potential for huge returns, 20–25% or even much higher. But, and this is a huge, but it's subject to extreme skew.
Extreme skew, meaning the results aren't evenly spread out.
Not at all. It's not like you invest in 10 startups and maybe 7 do okay. No. With angel investing, something like 89% of investments return zero or even lose money. All the portfolio's gains typically come from 1 or 2 massive home runs.
So you need diversification, expertise, significant capital, and a strong stomach.
And a lot of time for due diligence. It's a very active, very risky asset class.
Okay, one more.
Royalties. These could be from music, patents, mineral rights, things like that. Returns can vary widely, maybe 5% to 20%. They're often uncorrelated with the market, providing steady income streams.
And you mentioned using the Lindy effect here.
Yeah, or dollar age. The Lindy effect basically suggests that the longer something non-perishable has been around, the longer its future life expectancy. So, a royalty stream that's been reliably paying out for 50 years is statistically more likely to keep paying out than one that just started last year. Favoring assets with a proven track record and older dollar age can reduce risk.
Okay, so those are income-producing assets. What about things like gold, crypto, art?
We specifically exclude those from a core income-focused wealth-building strategy. Why? Because they don't generate any reliable cash flow.
Their value is based purely on what someone else will pay for it later.
Exactly. It's based on perception, sentiment, speculation. You buy a stock based on expected future profits and dividends. You buy gold or Bitcoin, hoping the next person will value it more highly than you do. It's a fundamentally different proposition, relying on appreciation only, not income generation.
Got it. Which brings us to another maybe controversial point, the case against picking individual stocks.
Yes. And this isn't just about potentially lower returns. It's about the emotional cost.
You shared an anecdote about a friend and GameStop.
Yeah, it was rough. Lost $12,000 in about 2 hours during that whole frenzy. Went through the full cycle. Fear of missing out, FOMO, crazy elation when it went up, crushing pain when it crashed, and then that long, lingering regret. Picking individual stocks can be an absolute engine for psychological torture.
And even if you can handle the emotions, the odds are just bad.
Statistically, yes. Something like 75% of professional, highly paid active fund managers fail to beat their simple benchmark index over 5 years. If the pros struggle so much, what chance does the average individual really have long-term?
There was another statistic about where market returns actually come from.
This one is mind-blowing. Research looking back to 1926 found that the entire net gain of the U.S. stock market, above just holding risk-free treasury bills, came from the performance of the best-performing 4% of stocks.
Only 4%. So the vast majority of stocks basically contributed nothing to the market's overall outperformance.
Correct. The market's gains are incredibly concentrated in a very small number of huge winners. Trying to find those needles in the haystack is incredibly difficult.
And even if you do get lucky and pick a winner, there's another problem.
Yeah, the existential dread. It takes years of performance data to even begin to figure out if you actually have stock picking skill or if you just got lucky. The feedback loop is incredibly long and noisy. And often, the reason the stock you pick soared has nothing to do with your original investment thesis anyway.
So why play a game where it's almost impossible to prove you're actually good at it and the odds are stacked against you?
Exactly. Just buy the whole haystack, the index fund, and just keep buying it. Focus your energy elsewhere. Okay, part V strategy. Dealing with timing, luck, and the inevitable roller coaster of volatility. The absolute core timing rule. We've said it before. Buy quickly, sell slowly.
Buy quickly because markets tend to go up over time, so waiting usually means paying more later.
Precisely. And this shows up in the data comparing investing a lump sum all at once, buy now, versus spreading it out over time, average or DCA.
How does that shake out? I thought averaging in was safer.
It feels safer emotionally, but historically, buy now wins most of the time. Data shows lump sum investing outperforms averaging in about 76% of the time. On average, it leads to about 4% higher returns annually.
So averaging in only really wins if you happen to invest your lump sum right at a market peak.
Exactly, which is hard to predict. But people are still tempted by the idea of timing the market, specifically buying the dip.
Everyone wants to catch the bottom right, be the hero who bought low.
Of course. So we look at a hypothetical scenario. What if you had perfect foresight, godlike timing? You knew the exact day the market would bottom out during any crash.
Okay, perfect timing. Surely that strategy wins, waiting for the bottom and pouncing.
You would think so. But even with that impossible advantage, waiting for the perfect bottom still underperformed just standard, boring, consistent dollar cost averaging in over 70% of the 40-year periods analyzed.
How is that possible, even with perfect timing?
Because major market bottoms, those really deep crashes, are actually quite rare. If you're sitting on the sidelines waiting for that perfect moment, you spend most of your time out of the market, earning nothing, while the market is generally trending upwards. You miss out on too much growth waiting for the rare catastrophic dip.
So consistency beats attempted perfection, even hypothetically perfect perfection.
Investing as soon as you have the money, as often as you can, is statistically the superior strategy.
This brings us to the uncomfortable truth about luck, doesn't it? We can control our actions, but not the environment we invest in.
Luck plays a massive role. Think about Stephen King writing books under his pseudonym, Richard Bachman.
Right, I remember that.
Those Bachman books sold, okay, maybe 28,000 copies. But when the exact same books were re-released under Stephen King's globally famous name, sales jumped to 3 million copies. Same product, wildly different outcome due to the luck of brand recognition and fame.
So luck, or maybe we call it context, matters hugely. How does this apply to investing?
It applies through sequence of returns risk. Basically, when you invest, matters almost more than how well you invest. Here's a stark example.
Okay.
Imagine an investor who was brilliant during a tough market period. They beat the market by 5% per year from 1960 to 1980, a period of generally low returns. Now imagine a terrible investor during a great period. They underperformed the market by 5% per year from 1980 to 2000, a massive bull run.
So skilled investor in a bad market versus unskilled investor in a great market. Who ended up with more money?
The terrible investor in the great market ended up significantly wealthier. Their bad skill was completely overwhelmed by the sheer luck of investing during a time when everything was going up massively.
Wow, that's humbling. The timing of your investment window, which is pure luck, can dominate your actual investment skill.
It's arguably the most important factor in your ultimate outcome, but you can't control it. So what can you control?
How much you save, the assets you choose, hopefully broad, diversified index funds, and how consistently you invest, your behavior.
Exactly. Focus relentlessly on what's within your control. And part of that control is learning to handle volatility.
The ups and downs, the scary drops.
They're unavoidable. Volatility is simply the price you pay for the higher long-term returns that stocks offer. Since 1950, the S&P 500's average maximum drop within any given year, the drawdown from peak to trough is about 13.7%.
Almost 14% drop on average sometime during the year. You have to expect that.
You have to accept it to earn the long-term gains. And trying to avoid it is incredibly costly. We ran a simulation. What happens if you try to sidestep even small drawdowns, say getting out whenever the market drops 5% or more?
Yeah. Sounds prudent, maybe. Avoid the little dips.
Result. Trying to avoid those 5% dips led to 90% less total wealth compared to a simple buy and hold strategy over a typical investment lifetime.
90% less. Why so drastic?
Because you end up spending almost all your time out of the market. You sell on the way down, but you rarely get back in quickly enough to capture the subsequent recovery, which is often sharp and fast. You miss the upside. You have to endure the downside to participate in the upside.
Okay, so don't try to dodge volatility. Embrace it. In fact, you argue that market crashes are actually opportunities.
Historically, they have been the best buying opportunities. I remember during the March 2020 crash, peak panic time.
Yeah, things felt pretty crazy then.
I was walking outside feeling the stress, and I saw this guy on a street corner just calmly arranging flowers he was selling. It was such a moment of normalcy. Amidst the financial chaos, it just grounded me, shifted my perspective. Life goes on, commerce continues. It helped provide that emotional anchor to just keep buying.
A moment of perspective. And the data backs up buying during crashes.
Emphatically. Looking back, buying U.S. stocks when the market is already down 30% or more has typically led to annualized returns of over 10% during the recovery period.
Okay, 10% plus after a 30% drop.
And if the market is down 50% or more, a really severe crash, the subsequent returns have often exceeded 25% annualized.
Wow. So when there's maximum fear, maximum pessimism, that's usually the point of maximum opportunity, statistically speaking.
The data screams, when there's blood in the streets, back up the truck and stick to the plan. Just keep buying.
Okay, let's wrap this up with part 6, the final rules. We talked about buying quickly. What about selling? The rule is buy quickly, sell slowly.
Exactly. Selling should be done deliberately and rarely. There are really only 3 broadly acceptable reasons to sell your long-term investments.
Okay, what are they?
1, rebalancing your portfolio. This means bringing your asset allocation back to your target mix, say selling some stocks that have grown excessively and buying bonds to get back to 60-40.
And the main goal of rebalancing isn't to boost returns, right? It's about risk.
Precisely. It's risk control. If you start at 60% stocks, 40% bonds, and never rebalance, after 30 years of stocks generally outpacing bonds, you might find yourself at 75% or even 95% stocks. That's a much riskier portfolio than you intended, especially as you approach retirement. Rebalancing dials that risk back down.
Okay, rebalancing for risk. Reason number 2 to sell.
A fundamental change in your belief about an asset. If the core reason you own something disappears, maybe a company completely changes its business model for the worse, takes on unsustainable debt, then the thesis is broken and selling makes sense.
Makes sense. And the third, most common reason.
Funding the life you need. This is when you sell investments to pay for major life expenses or goals.
But there's a hierarchy here too, right? Prioritize needs over wants.
Absolutely. Prioritize safety and essential goals first. Sell to build up your emergency fund if needed. Sell to pay off high-interest debt. Sell to fund education or a down payment on a home. These are foundational. Only after those needs are met should you consider selling for purely aspirational wants.
And if you're selling a position that's done really well, maybe a concentrated stock holding, sell slowly.
Yes, generally sell slowly. This helps manage the tax implications, spreading capital gains over multiple years, and also reduces potential regret. If you sell everything at once and the stock doubles again next year, that feels terrible. Selling gradually smooths out the emotional ride and the tax bill.
Okay, buy quickly, sell slowly and deliberately for specific reasons. Let's tackle the 401k dilemma, Roth versus traditional.
This one's actually simpler than people make it. The core question is, do you want to pay income taxes now, Roth, or later, traditional? You should aim to pay taxes when your effective tax rate is lowest.
Which is usually later in retirement for most people.
Often, yes, especially since traditional contributions give you more optionality. You get the tax break now, and you could potentially convert portions to Roth in retirement during low-income years, or perhaps just pay a lower marginal rate on withdrawals than you would have paid on contributions during your peak earning years. Traditional generally offers more flexibility.
Okay, now, for the really controversial take you mentioned earlier, maybe you shouldn't max out your 401k beyond the employer match, at least not automatically.
Right. This goes against almost all standard financial advice, but the data is surprisingly compelling when you dig into it.
Explain why tax advantage growth sounds unbeatable.
It sounds great, but when you actually model the net long-term benefit of a 401k compared to a well-managed tax-efficient taxable brokerage account, using things like index funds, tax loss harvesting, the extra benefit from the 401k's tax deferral is often quite small, on average maybe around 0.38% per year.
0.38%, that's it. That seems tiny.
It is surprisingly small. And here's the kicker. That tiny potential benefit can easily be wiped out, or even turned negative, by the fees within the 401k plan itself. The average 401k plan cost is around 0.45% per year.
So the fees could eat up more than the entire tax benefit.
In many cases, yes. So you have to ask yourself, is it worth locking up my money until age 59 and a half, potentially restricting my ability to access it for major life goals like buying a house when I'm younger, all for a potential net benefit that might be zero or even negative after fees?
That really reframes the decision. It's not automatic. You need to weigh the small potential tax advantage against the huge cost of illiquidity, especially early in your career.
Exactly. Getting the employer match is crucial. That's free money. But beyond that, aggressively maxing out might not be the optimal choice if it prevents you from saving for other important near-term goals that require liquid cash. It's a personal calculation based on your goals and your specific 401k plan's quality and fees.
Fascinating. Okay, let's talk about the psychology of wealth near the end here. You argue that, ultimately, you will likely never feel rich.
It's a hard truth, but wealth is intensely relative. Look at Jack Whitaker, the guy who won a $113 million Powerball jackpot. Even when he reportedly still had $17 million left, he was still playing the lottery. He didn't feel subjectively rich enough.
Why is that? Why does the goalpost always seem to move?
A big part of it is the friendship paradox. It's a phenomenon from social network analysis. Statistically, your friends, on average, have more friends than you do. Applied to wealth, it means the wealthier people in your social circle tend to be connected to more people, making them more visible and overrepresented in your network.
So you're constantly comparing yourself upwards to these highly visible, wealthier connections.
Exactly. Which naturally makes most people feel less wealthy than their peer group, even if they're objectively doing very well. Unless you are literally the single richest person on the planet, you can always point to someone wealthier and say, see, I'm not rich, they are.
Even people way up the income ladder feel this way.
Oh yeah. Data shows households at the 90th percentile of income, objectively very well off, consistently underestimate how high up they actually are on the financial ladder. The feeling of rich is a psychological mirage for almost everyone.
So if chasing the feeling of being rich is futile, what should we focus on? This brings us to the most important asset.
Time. Absolutely, unequivocally time. Think about the classic thought experiment. Would you trade places right now with Warren Buffett, age 87, when the scenario was posed for his entire multi-billion-dollar fortune?
Get all the money, but be 87 years old with maybe only a few years left? Most people would say no, right?
The vast majority say no. They intuitively value the decades of life they potentially have ahead of them more than all the money in the world. Time is the one asset you simply cannot buy more of.
And time is what makes investing work its magic through compounding.
Compounding needs time. And perseverance needs time. Look at the incredible story of Dasrath Manji in India.
What did he do?
He spent 22 years, single-handedly, using only a hammer and chisel, carving a 360-foot-long path through a mountain to connect his village to the nearby town after his wife died, needing urgent medical care they couldn't access quickly. He leveraged his time, his perseverance over decades, not financial capital, to achieve something monumental.
Wow, 22 years. That's dedication.
And critically, think about when your income grows fastest. It's usually in your first decade or so of working, roughly ages 25 to 35. That's when you have the most potential to increase your human capital value.
So optimizing your career, your skills, your income during that early high-growth window, that's more important than agonizing over the asset allocation of a tiny starting portfolio.
Absolutely. Investing in your skills and career trajectory when you're young leverages your most valuable asset, time, to build the income that will fuel your investments for decades to come. Invest in your time first.
Okay, that brings us perfectly to the conclusion. Let's recap the core just keep buying rules for playing the financial game in a way that maximizes your probability of success no matter what the future holds.
Right. The key takeaways. Focus on growing your income, especially early on. Use the 2X rule to spend guilt-free by matching splurges with saving or giving. Save 50% of your future raises to keep your timeline on track. Avoid the emotional and statistical trap of trying to pick individual stocks.
And always, buy quickly, invest as soon as you have the money, but sell slowly and deliberately. And above all, recognize and value time as your most precious, irreplaceable asset.
We started this deep dive talking about accumulating wealth. But the data and maybe life experience shows that chasing the feeling of being rich is probably a losing game because of relativity. But time is the ultimate non-monetary asset. It drives compounding, enables perseverance, and ultimately defines our lives.
So we'll leave you with this final provocative thought to chew on. If you accept that you can almost always figure out a way to earn more money, but you can never buy more time, what single action could you prioritize today related to your career, your skills, your human capital, essentially, maximizing the long-term value of your time that would have the biggest impact? Think big.
And in the meantime,
Yeah.
just keep buying.